And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Of course, it is Wednesday, hump day. Here we are getting ready to get finished up with the first week of the month, and nothing really much going on. You know, just had a little speech last night, stayed up too late watching it, so I'm dragging a little bit this morning. I thought it would be like a 40-minute speech. It was 100 minutes. I hung in there, though. So anyway, lots of interesting talking points last night. Of course, what's really kind of driving markets yesterday is tariffs. So we're going to spend a little bit of time this morning talking about tariffs. Kind of some of the things that President Trump talked about last night in regards to tariffs, what that may mean. Of course, markets have been under a lot of pressure. And as we talked about in yesterday's article on our website, so if you go to the website, realinvestmentadvice.com, or go to Substack at Lance Roberts, I have an article out yesterday talking about bearish sentiment. And sentiment now has reached levels that is more normally associated with very deep market crashes like the pandemic, that 35% decline, the financial crisis. We haven't seen levels of bearishness like this very often. Markets are extremely worried. And it was interesting yesterday, I got a call from Fox Business and they asked me to come on Charles Payne to talk a little bit about that, because we started buying yesterday. We bought some Google, we bought some Microsoft yesterday, started kind of nibbling into some of these really kind of beaten up stocks. We'll probably do some more today. But, you know, so I went on Fox and I was talking about, hey, these are very deep oversold conditions that we're getting, not just in the market technically, but sentiment-wise. And these don't happen very often. And typically they lead to a better outcome for investors. And again, our job as investors to do what, right? Buy high and sell low. Sell high and buy low, right? And see, this is the thing where everybody gets caught, right? Because when markets are going up, it's like, oh, I want to buy. And then when markets are going down, and I got just a ton of text messages yesterday, emails, tweets, etc., from people, you know, that had watched that segment going, why are you buying here, right? But this is exactly when you want to buy, right? You want to buy stuff when nobody else wants it, and that's kind of where we are right now. And here's the interesting thing: this is a 6% decline, right? And so as John and I talked a little bit about yesterday, a 5% decline happens a couple of times a year. That's very normal. This is just a very normal overbought correction. Markets were overbought. They corrected here a bit. We're down 6% from the peak. Small caps, though, that's a very interesting story. Small caps are down 15% from their peak. Now, here's what's interesting about that. Right now, Wall Street analysts expect earnings for small cap companies, say the Russell 2000, to be up by 20% this year. The market is not agreeing with that assessment because of what's happening both economically as well as what's going on with tariffs. And again, we'll talk about that this morning. But those impact earnings for small and mid-cap companies much more than they do for large-cap companies, which are more international-based. But nonetheless, markets are getting fairly deeply oversold. On a MACD basis, we're down there. And we're going to talk some more about this in a second when we do the before the bell update. But this is really the goal, right, of investing, is to look for opportunities where markets are very, very oversold, and we're there. I mean, just the sentiment is just very, very negative. So what does all this mean, right? So again, lots of concerns over tariffs. That's going to be the driver here. That's the narrative. Markets are overbought, and as we've talked about before, the one thing that kind of gets markets from time to time is a change or an action or an event that causes a change in sentiment, and markets have to reprice what's going on in the markets. And this is key, right? So this is very key to the outlook of your investing program and what you're doing with your own portfolio. So here's what you need to know before the bell this morning. So as I was saying, yesterday, the markets are very bearish, very oversold. We're down 6% from the peak. This is the time where you should start to look for an opportunity to invest in the markets. Now, does that mean the markets are absolutely in the position where they are going to go just up from here, right? Don't know that. The problem with finding a market bottom is that it takes time to work that out, right? Because you need markets to kind of spend some time consolidating a bit and looking for an opportunity to start to rebound from very oversold levels. And this is kind of where we are at the moment, is that for the first time in quite some time, the market actually retested the 200-day moving average. We haven't been down to the 200-day moving average in a very, very long time. We got close to the 200-day moving average last July. We haven't even touched it. We didn't even touch it back then, but now we've actually tested the 200-day moving average yesterday. So this is something that hasn't happened in the markets very often as of late, but we did successfully test that level at the 200-day moving average, bounced off of that. We do have a cluster of resistance sitting up right around 5,900 on the S&P. That's the 20-day, the 100-day, the 50-day. They're all clustering right there. So there's going to be some very tough kind of ability for the markets to rise above that just at the initial run. It could certainly happen, but most likely we're going to be kind of trapped in this consolidation range here for a bit. But it certainly doesn't mean that we can't see markets begin to start to recover here a bit and start to see a little bit more positive price action. Again, as I was talking about, previously, this oversold condition in the markets has now pushed this MACD indicator to some of the lowest levels that we've actually seen in quite some time. So we've got a very, very oversold condition in terms of momentum. We have a very oversold condition in terms of relative strength as well. And again, previous conditions like this, where you've had a very oversold level that's been bought, that is typically kind of lined up with a temporary market bottom. This kind of goes back in history. So again, I'm not saying this is the next great buying opportunity for the next major bull market that's going to take off from here. But this is probably getting close to a level where you're going to get a reflexive rally in this market and then use that as an opportunity to rebalance risk in your portfolio. If you're really worried about this market that's could potentially go down 20%, right? We could have that bigger crash that everybody's been hoping for the last couple of years. That's not going to happen all at once. You're still going to get an opportunity. So when this market bounces and we get back up towards that 5,900 level, take a little bit of money off the table, right? There's an opportunity here for a tradable rally. That's all it is, right, at this point. Now, if that matures into a more stable, longer-term rally where markets kind of get their feet back under them and we begin to rally again, set it, and we get above these moving averages, set a new high, well, then that's okay, right? You've still got exposure to the markets. But again, it's just, you have to manage your risk levels, manage your kind of exposures where you want them. But again, we have just started to reach such negative levels here in terms of sentiment, positioning, momentum, that those are generally a decent opportunity here for again, a reflexive rebound in the markets that you can then either take advantage of or use to rebalance and reduce risk in your portfolios. Now, we're not just seeing it there. As we kind of talked about the other day, part of this decline has also been a decline in the dollar. We've seen we talked about this previously, is that the dollar had gotten very, very overbought, was due for a correction. We're down to the 200-day moving average on the dollar as well. So part of this pressure has been outflows from the dollar. We had a lot of foreign inflows coming into U.S. markets over the last year. That was a function of this rising dollar. We've had a reversal of that, so that's part of what's been weighing on the asset markets as of late. That's part of this decline that's going on. Again, we're very, very oversold on the dollar now, so if we start to see a counter trend bounce in the dollar, that should also feed back into money flows coming back into and from foreign inflows back into U.S. assets. And then on the other side of this, bonds have now gotten extremely overbought. Again, great rally here in bonds. They've been an awesome hedge to portfolios this year. But we're flirting right now with a very overbought condition. They ran right into the 200-day moving average yesterday, sold off a bit here. Would not be surprised with such an overbought condition in bonds short term that we get a pullback towards the $90 level on TLT as an example. That would probably put the 10-year Treasury rate somewhere probably around 4.3%, maybe 4.4 on a rally. But actually interest rates did take out the 200-day moving average yesterday, rallied back to that. So we'll see. So at 4.2, that was around the 200-day moving average for interest rates. So we've had a first really kind of initial break of support for 10-year Treasury bonds. They are, again, interest rates are very, very overbought here, just like bond prices. So again, expect a little bit of a reset here, but if we continue to kind of build a downward trend in rates, that's going to start to align with the weaker outlook that we're seeing right now for economic activity, as well as lower rates of inflation, which are all starting to kind of manifest themselves. We've been talking about that really since last year, so a lot of this data outlook really isn't there and supportive enough for a continued rise in inflation. So we're starting to see some of that reversal now. Okay, that's what you need to know before the bell this morning. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year.
What are you going to do with all that extra income?
Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets.
Saturday, March 29th.
Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to this morning's edition of the Real Investment Show. Danny Ratliff joining me. Hello, good morning. Morning. So again, talking a little bit about tariff turmoil. Very interesting. Markets have been under a lot of pressure for the last few days because of concerns over the implementation of tariffs. Really, kind of Monday was a lot of that. Because Trump's talking about we're going to institute 25% tariffs on Mexico, Canada, 20% tariff on China, or increasing from 10 to 20%. And it was interesting last night if you listened to the joint address to Congress. He actually talked a lot about this, and he made a couple of very important points about tariffs, and this is kind of what's overlooked, is that first of all, tariffs are not a new thing to our country, right? This is something that from 1915 to 1940-ish, about 85% of all of our revenue came from tariffs. So tariffs and excise taxes. Income taxes were very, very low level in the country back then. Wouldn't you like that, to have low taxes again? And that's kind of his thesis, is that if we can start extracting more income through tariffs from people who buy products, goods, and services from us, or who were buying stuff from them, that we can reduce the tax burden on U.S. citizens allow them to keep more of their money, which they would then spend in the economy, helping economic growth, which would generate more revenue, right? So that's kind of the thesis behind his view. And this is, whether or not you agree with that's irrelevant. That's his view. This is kind of where he's headed. Now, part of the conversation that kind of gets lost in a lot of the media headlines and the narratives is like, oh, we're the only people tariffing other people, right? And like, oh, we're instituting a tariff on Canada or Mexico, and that's so unfair to those. They already tariff us. And this was a point that he made last night, is that a lot of other countries already have tariffs on things that we sell to them, right? So they're already tariffing us. And so he talked a lot about reciprocal tariffs. A lot of these are reciprocal tariffs of things that are going on. And so why would you do that, right? Why would you come out and just, say, I'm going to have a reciprocal tariff? Well, there's two aspects for that. A, you want a fairer trade deal, right? So if you're going to tariff me, great. I'm going to tariff you the same amount on the same products. So we each have a tariff on each other. You don't like it. I don't like it. So what's the outcome of that? Well, the outcome of that is negotiation. And that was something that Lutnick mentioned yesterday, is that this is, and we've talked about this on the show before, is that tariffs are the stick and carrot routine of this administration, which is, here's the stick of tariffs. And if you want to negotiate a better trade deal for us, that's the carrot. And I'll take the tariffs off. And so today, futures are rising because of this expectation that tariffs may not be around very long, or won't be as severe as what's currently being suggested. And that has some implications to markets. Now, here's the thing that we talked, though, about yesterday, and when I did the interview with Fox Business, here's the important thing. And Danny will attest to this because he's getting phone calls right now as well from clients who are very worried about their portfolios. How do markets work? How do markets work? This is a very, very key point to understanding what's happening in the markets itself right now. So as we talked about before, markets are related to earnings and the ability to generate earnings growth. So if companies are growing earnings, stock prices will rise in anticipation of higher earnings growth. If something comes along that changes that outlook for earnings growth, so I'm not going to grow earnings at 10% now, I'm only going to grow earnings at 5%, markets have to adjust for that. So as a function of that, I slap a tariff on all goods. Let's just say we're going to put a 25% tariff on everything we sell, or everything that goes everywhere else in the country, right? So all of a sudden, that's going to reduce corporate profitability. That will reduce corporate earnings because corporations are the ones that pay the tariffs. So the markets have to reprice for that. Now, here's the point. As investors, what we have to determine is when that repricing has been completed. See, the attitude right now by a lot of individuals, and this is what you see in the sentiment indexes, et cetera, is that there is no bottom floor to the market, right? It's just, we put on tariffs and now we're going to, the markets are declined by 30 or 40%. That's not how markets work. Markets right now, the reason markets are down 6% on the S&P, 15% on the small cap stocks, is because those stocks are being repriced for lower earnings due to tariffs. So what our job is as investors is to find out when, or at least to figure out to the best of our ability, when most likely those assets have declined enough to compensate for the impact of tariffs on earnings, right? And so that's the exercise we have to go through right now. Then so we start looking at valuations, we start looking at a lot of different things in the markets, figuring out, well, if earnings growth was this, we subtract a tariff impact. What's futures earnings growth? Now look at valuations on a forward basis, and you can start making a better decision.
Yeah, and I think that one unique aspect of what's going on is that these tariffs, everybody keeps saying, well, the Trump put is gone, meaning that, he had that insurance policy, and we've talked about how, that first term, maybe he was judging himself on the market, whereas now it's a little bit different. But not only that, with that stick and carrot approach, things can change quickly. And so today, as you mentioned, the market's rising because we eventually think that Howard Lutnick, the Commerce Secretary, says, hey, we may make a deal. But ultimately that was the end goal. And so that's what makes it difficult in this environment to say, okay, hey, let's go ahead and, I'm getting lots of phone calls saying, let's get out of the market altogether. We don't need to be here. I don't see any upside. Well, I think there can be a lot of upside. I mean, you could see a peace deal with Ukraine and Russia. The market would likely react favorably. You could see, obviously, something different happen with these tariffs where you bring it back, you work out a better deal. Now, I'm hearing everything from, understanding diversification, where should you be, to being out of markets, to the dollar's going to go away.
Yeah.
That's the new one today or this week. And I think it's difficult when we get so much different information and we get that paralysis by analysis. Right. And sometimes, you've mentioned this before, sometimes it's better to do nothing initially.
Right.
Because we make those emotional decisions. And that's what I'm hearing and seeing a lot more of. And, we look at investor sentiment. You've talked about how this is lower than what we had in 2008. This is lower than COVID.
Right.
And we have a 6% decline. And this was actually lower when it was only 4%.
Right. And look, I get it, right? There's a lot of unknowns, and again, a lot of speculative sentiment in the markets, those type of things. And so again, this all makes sense. Brent, can you bring this chart up for me? So, but I do want to show you this. This was Charles Payne brought this up on Fox Business yesterday while we were talking. This is a heat map, and you can do heat maps in a lot of different ways by looking at, the price of the market, is it up or down, relative on the day, et cetera. This is a heat map of valuations in stocks. And again, a lot of impact right now over tariffs, and particularly on tech stocks. The mega cap stocks have certainly been under a lot of pressure. It's worth kind of noting that a lot of these mega cap stocks that have been under a lot of pressure are not really all that expensive. NVIDIA is trading at 20 times forward earnings. It's actually cheaper than the S&P. Google's at 17, Meta's at 22, cheaper than the S&P. Now, there's certainly still some companies trading at more elevated valuations. Microsoft's a good example. Apple's still trading at 28 times earnings. By the way, cheaper than the S&P as a whole, but still there. But look at there's a lot of stocks that are trading. JP Morgan yesterday was down about 4 or 5% early in the afternoon. That's trading at a fairly deep discount relative to the overall market. Bank of America, Wells Fargo, Merck. There's a lot of, the point is that be careful with this idea that the whole market is grossly overvalued just because we talk about CAPE ratios or whatever it is. Yes, there are certainly some stocks that are overvalued, and you need to be aware of that. But there's a lot of companies, and again, kind of we immediately throw in the basket, NVIDIA is just, it's got to be super overvalued. It's not really that expensive because of the rate of earnings growth that it has. So again, we got to keep this all in perspective when we're managing our portfolios and be looking for those opportunities when they present themselves, because that's how we make money going forward. And again, it doesn't mean, and again, one of the big misnomers is if you buy something, you can never sell it. And that's just simply not true. So we'll come back though. I want to switch gears, talk a little bit of tariffs. So this is the big concern right now, but also stagflation. We'll get into that with Danny Ratliff right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your question about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Anybody that's been married at all knows this to be a true story. If you tell your wife something that you know for a fact to be true, she won't listen to you. But if she hears the exact same thing from a girlfriend or from somebody else, it's gospel.
The Real Investment Show podcast.
Danny came up with this idea that we create a fake Facebook page and that you can all subscribe to, and then we will create a fake profile that will answer her in her feed. This is what you need to do, even though it's the exact same information that you just told
At
her.
realinvestmentadvice.com.
I like it. I like this a lot, actually.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, as we talked about this morning, the dollar's been on decline lately, not surprising. And again, this is always kind of the fascinating thing to me, is that if you take a look at a chart of the dollar and you go back to October of 2022-ish, dollar had sold off a good bit, and there was all these headlines about, oh, the world's de-dollarizing and nobody wants the dollar anymore, and it's doom and gloom and the world's going to crash, and that was the bottom of the market. And Mike and I wrote articles about why that wasn't the case. And of course, you've had this very strong rally in the dollar. It's absorbed just a ton of inflows into the United States, and that's been helping support the financial markets. And now, not surprisingly, you get some market weakness. Those dollars are going to leave out, right? Because I'm going to move that money back. I'm storing my reserve currency in the dollar, so I'm going to pull it back. So you get a sell-off in the dollar. Dollar ebbs and flows, right? But already we're seeing headlines about, oh, everybody's de-dollarizing it. No, it's not the case. It's just every asset in the world trades. And so when it gets really overbought, it's going to get sold off. And then that's when you'll have a good opportunity to buy dollars cheaper, right? And that's what's going on here. But but all these things that go tariffs, etc., are all good headline generators. And we talked about on the show, bearish headlines certainly generate a lot of clicks and views. So the more bearish I can be about it, the more clicks and views I have. I bet I could have, another 100 subscribers today if I said markets are going to crash, right? Oh, click and subscribe, by the way. But, stagflation's the new one, right? Stagflation is the new moniker out there to help scare people into making bad decisions. And what's fascinating to me is that nobody seems to understand the very basic definition of stagflation. Here's a winner for you. We've never had stagflation in the US because stagflation requires three components. Now, let me just read to you what's going on from CNBC this morning. A growth scare in the economy. Yes, we're definitely having a growth scare right now. We warned you that the economy was going to slow down, right? You're just all that money we injected. It's coming out. As it comes out, you're going to get slower economic growth. So we're having a growth scare. A growth scare in the economy has accompanied worries over a resurgence in inflation, threatening a potentially risk of rekindling stagflation. So slower economic growth, higher inflation, that's stagflation, right? No, it's not. Stagflation is low growth, high inflation, and high unemployment. It requires 3 components for stagflation, not 2. So again, the moniker is very nice. Stagflation. That article got a ton of clicks and views. Danny clicked on it because he sent it to me this morning. Lance, are we having stagflation? No, we're not having stagflation.
No, I know we're not having stagflation. The challenge is that's what everybody believes. But think about this. This is what they wanted.
Right.
They wanted to slow down the economy. They wanted to bring inflation down. They wanted actually unemployment to tick up.
Correct.
So these are all the things that we knew were going to happen. Now, it's to what extent does it happen and how bad does it get? Does this push you into a recession? Do you have ultra high unemployment? We're nowhere near, that's what the funny thing about the sentiment aspect is. We're nowhere near the 8% we saw back in 2008, 2009. We're not even near where we were in 2022. But this is the headline because of the tariff noise. It's we have to fight a lot of different misinformation and information in general. And I think it's always good to get kind of understand both sides of the coin and different perspectives. But a lot of this is just misleading. And while this could occur, it's not here now. We are seeing slower growth. We are seeing a little bit higher unemployment. Everybody's hearing about more layoffs. And, one of the big ones, obviously, is the government. But if we're truly going to get set up for that quote unquote golden age, you're going to have to cut the fat.
Right. Well, and true, but going back to the very basics of stagflation, so Brent can bring this chart up for me. So again, you need 3 factors. And yes, unemployment is going to tick up. If we have a slower economic environment, unemployment is going to tick up. But you have to remember, unemployment's at 4% right now. That is not an elevated rate of unemployment by any stretch of the imagination. In fact, it's some of the lowest that we've had historically. So if we go back in history, right, go back to the 70s, that's where everybody relates back to, oh, well, that's when we had stagflation. Yeah, we had high inflation and we had high unemployment back then. But you also had very strong rates of economic growth.
And you had wage growth.
So you didn't really have stagflation back in the 70s because the economy was booming. We're growing about 8% at the time, and inflation tracks economic growth. So you had inflation because you had very strong economic growth. Economic growth creates higher prices, right? As the stronger the growth is in the economy, the higher prices that you can charge for goods or services. So you never really had stagflation back in the 70s, but this makes great headlines that, oh my gosh, we're going to have stagflation. The reality, though, is that we're running fairly low unemployment right now. And yes, unemployment can certainly tick up to around 5%-ish, more than likely. Now, if we get into a recession, it'll be a very different story. But if you get a recession, you don't have stagflation because you can't have inflation during a recession. So this is the problem with that narrative, and it's great for headlines, and it's great to scare the bejeebers out of you. But the reality is that inflation is tracking economic growth. Inflation's about where it should be. We're seeing inflationary pressures continuing to decline really in many facets of the economy. And if we continue, and if you take a look at the Tru-flation index, that's one of people's favorites, because it was showing this kind of this rise in inflationary pressures. That thing has completely dropped off the cliff over the last couple of weeks. That's a real-time indicator of about 30,000 different products, right? And that has completely collapsed in the last few weeks. So again, all this concern is great for headlines and clicks and views, but again, we have to focus on what's driving markets right now. And right now, it's all about tariffs and concerns about that. Markets are repricing for potentially the impact of tariffs. And the question you have to ask yourself is that if there's a particular stock or investment or whatever it is that you want to make, has that repricing process been completed yet, or do you think there's more to go? And again, whatever your reasoning is and whatever you think is the case, that's fine. right? Everybody, that's what makes a market, right? Everybody has a different view. We're looking at asset prices that we either, and things that we either own or want to own, and saying, this is really, really oversold here. We have an opportunity to add to our positions. We did some of that yesterday. We'll probably do some more today. But that's our job as portfolio managers. So again, as managing your own money and doing your own risk management in your portfolio, you've got to make those own decisions. Just be careful. And the whole point of this conversation is, whether it's tariffs or whether it's stagflation, is not to let emotions drive your investment decisions. That's, this all goes back to the same stuff that we talk about on the show all the time, is managing your behavioral conditions. And the mistake that we make, and Danny will tell you, he gets phone calls all day long about, we should just sell everything. Have you seen the headlines? That's exactly what headlines do. They make you want to just make drastic decisions. As we talked about before, sometimes the best thing to do is nothing, and just let the markets work themselves out and just go from there.
Yeah, and keep in mind, we're not saying there's no inflation. I mean, clearly you can see it in the numbers, right?
Sure.
You're seeing it with steel, aluminum. Those are going to be issues if that continues. The big one everybody wants to talk about is eggs. It's like, I had a conversation yesterday. I said, listen, most people don't feel inflation until they go to the grocery store, and that is what the main,
right. And that's a super great point.
Yeah,
because that rate of inflation has absolutely nothing to do with the markets. And that's and this is the key point. So as investors, right, this is the thing we have to understand, is that again, when you get the CPI headlines that come out, everybody means, apparently nobody goes to the store and buys eggs, right? I mean, I remember back in 2007, 2008, a Fed member came out and said, have you seen the price of iPads? iPads had come down in prices. And one of the reporters said, well, you can't eat an iPad, because we were talking about inflation back then. And but the difference is, what you and I see as consumers has nothing to do with the inflation rate in the market. And what I mean by that is that the market only pays attention to the CPI index or the PPI index or the PCE index, and the relation to that of what the Fed will do. Inflation could be 15%, but if the market says that the Fed's going to have to drastically cut rates, the market's going to rally on that number, right? So again, we have to separate out what you and I see at the markets, at the price of eggs or the price of gas, and say, what is the market looking at? And what is the numbers that are moving the markets? Because the markets only pay attention to the direction of CPI. They don't pay attention to the price of eggs.
Well, but it's going to force people to make decisions. Are you going to continue to buy eggs? Are you going to continue to buy avocados? Whatever it may be that you want to put it to.
If you're trading eggs, that's very important.
Yeah. Or are you going to go buy something else? Or cut back. I mean, and that's what happens, where you do see over time, where if you do get that larger spike in inflation, a lot of times it does lead to that disinflation or even deflation if you get into that bigger recession. And that's one thing I think that, we've been conditioned to think that we cannot have a recession, but yet the market talks about it all the time for those clicks. And that's what the Fed has done, where they have been that Fed put to try to really take a recession out of the business cycle. We could probably argue, you look at that heat map that you pulled up earlier, Lance, and a lot of those valuations are actually much better than what most people would think when you actually look at it one by one. Now, when you also look at that heat map, you see the sheer size of some of these companies that really, we could have a bad day in those companies and you can see the market go down, right? But the remainder of the market could go up. And we've seen a lot of rotation over the last week or two.
Absolutely. Yeah, the value rotation has definitely been on. And so this is why it's always great to have some value in your portfolio always. Yeah, it lags sometimes, but when the market gets volatile, value is generally a good play. All right, quick break. We'll come back. Get ready to wrap up the show with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Social Security Fairness Act dropped elements that reduced Social Security payments, retroactive to last year. What are you going to do with all that extra income? Our next Candid Coffee offers savvy Social Security planning if you were dinged by windfall and pension offsets. Saturday, March 29th, Richard Rosso and Danny Ratliff answer your questions about Social Security benefits and what the removal of WEP and GPO means for your retirement. Candid Coffee with Ratliff and Rosso. Register today at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So again, just a lot. The point of the show this morning is just to be aware of headlines and, a lot of things that are going on right now, tariffs and, concerns about stagflation, concerns about all these things. And again, it doesn't matter what you believe personally. It's fine. And the point is, and I'm not arguing with you over this or that or the other thing. Our point is just to separate out headlines and media bias from your investment strategy, whatever that is. You can be super bearish to the market. That's awesome, right? That's fine. Whatever you want to do is fine.
The market does not care.
Yeah. The market doesn't care. The only thing that matters to you is whether or not you're making money at it. And our goal here on the show is to help you make better decisions about where you're investing, how you're investing, so you can make money. Because look, we have one job for our clients, or I have one job for my clients, which is to make money for them because I manage the portfolios. Danny handles all of the important stuff, the financial planning, the estate planning, the insurance planning. I've said before, is like what I do is the least important job in the whole firm. But our job is to make money for our clients. And
say that again.
I've said it numerous times.
No, I know.
I've said it numerous times, and it's true. I mean, and people, that's the unfortunate thing, though, is that people don't really understand the value of having a financial advisor. Everybody has doctors, but they really don't understand the value of a financial advisor. They just think it's about portfolio management, and that's the least important aspect of.
But that's the sexiest part of what we do in a lot of ways, right? Because
that's
nobody wants to talk
me.
about planning. No, that's why we never mind. Not even going to go there. But it's critical, right? Because that's the thing that most people think about first. When you think about markets, when you think about your money, you think about where is it at, how do you invest, what do you do? Whereas, what we're trying to do, which is certainly not the sexy part, because nobody wants to talk to somebody where they think, and I can't tell you how many people I've visited with, you're like, I don't want to do a plan. Well, why would we not want to do a financial plan? Well, I don't want you telling me how much money I can spend. I said, whoa, hey, hold on. This is your money. We're your advocates. We want to make sure that we're putting you in the right place to minimize taxes, to keep money in your pocket, to stay ahead of new legislation, laws that may impact you, find ways that you can keep more money in your pocket and out of Uncle Sam's legally. But you know, those are the things that I think are challenging in the sense that nobody wants to talk about their mortality. Nobody wants to talk about, you know, the big picture, or many times they don't. But in order for Lance to do his job properly and make sure that we're allocating, you know, assets accordingly, those are things we need to know. We need to be able to put those two together and marry those. Yeah. And that's why we have a hurdle rate. You know, we talk about what is the minimum rate of return that you need to reach to achieve your goals. And it may look different how we manage money and how you manage money. And, you know, I visited with the gentleman yesterday, really smart guy, had built a portfolio that is really just to achieve income. Mm-hmm. And we had a conversation, said, look, you know, we can certainly build income into this, but we're going to have a growth component. How you're currently set up really doesn't have much opportunity for growth. And so it's almost changing perspectives in a lot of ways as far as the money management aspect of it. And then also taking that kind of the behavioral mindset, like you were just alluding to, that we all have our biases. And, you know, hey, I've been invested this way because of this. I've slept well at night, but I know this is probably not conducive to long-term growth. And so finding out exactly what that is and what that should look like, and it's different for everybody, but also because we can proactively make moves, it gives us a little bit of it's a real benefit in a lot of ways, but in other areas, it can be a challenge in the sense that we hear so many times, like, because we actively manage money, people think you have a magic wand, right? Right. I'm like, shoot, if we had a magic wand, we'd be on the beach with a coconut drink in our hand and a fishing pole, right? Life would look a little bit different. But you know, that's the things that we have to remember. And so while your job certainly is, you know, a lot more fun in that aspect from, well, I don't know. Depends on the day, right?
I don't know if fun's the right term, but
well, I think we all enjoy what we do.
It's interesting.
Yeah. But I mean, this markets over the last several years have presented, you know, a lot of headwinds in many ways and tailwinds in others. And that's been the most difficult part about it has been, you get so much different information, even going back to 2020. Okay, hey, we think we know what the market's going to do. We think we understand where the economy is, and then boom, more stimulus. And now we're kind of dealing with that on the tariff. So the opposite end of that. But at some point, that will end as well.
Right. Well, yeah, again, you know, the kind of the point that is for, you know, kind of the whole show this morning is just controlling ideas. And again, you were just talking about rates of return and building a portfolio for income. And you know, it is important, and I see this a lot. You know, I just had a guy email me the other day. Is like, hey, look at my portfolio. It says I'm generating income off this, and to kind of your same point is that there was no growth component to it, and I was like, well, this is fine, except the problem is that inflation is going to go up every year, and you've got to make sure that your income you're generating is adjusting for inflation, which means you need the growth in the portfolio as well. So it's a really fine line between managing a portfolio for income, because you've got to make sure that the portfolio is adjusting that income. This is a big problem with a bond portfolio. People say, I just want a bond portfolio. Just give me 100% bonds. And the big problem with that is it's great. You're guaranteed that over the next 10 years, you're going to get 4% a year. So yes, you know, all I want is 4%. So I'm just going to buy treasuries and we have 4% a year for the next 10 years. That's awesome. The problem is that the next 10 years, inflation is going to go up 2% a year every year. And so that 4% you're getting in 10 years is not going to be worth very much in 10 years. And so all of a sudden, it's not generating what it's supposed to do. You know, if it's different back in the early 80s, you could buy 10-year treasuries at 17%. You didn't need to worry about inflation adjustment. It was doing the job for you at 17% a year. That's not the case anymore. And so you've got to have a portfolio that generates both income, and it's fine, and income is an important point. When you build your portfolio, you should think about your portfolio as being a stool with 3 legs. And in order to have a well-balanced stool, you need capital appreciation. That's the growth component that adjusts for inflation. You need dividend income. That's part of your income component. And then you need your bond income, which provides your stability in the portfolio, provides your basis of lowering your volatility in the portfolio, but also provides a steady income stream because you get that return of capital in the future. So you have your income, your dividends, interest income, your dividend income, and then your capital appreciation. Those are your three primary components. So when you look at your portfolio, do you have those three components? Are they all working together, and are they balanced properly? And if you do that right, you can get both growth and income out of your portfolio and have it adjust for inflation over time.
Yeah, and I think that's one thing that we've seen a lot more people kind of all in or all out, one way or the other. And, the diversification aspect, that term's probably thrown around a little bit too loosely, because you hear, modern portfolio theory, you must be in large cap, mid cap, small cap, international, all the way down every sector, asset class. And, never, we're going to tweak it a little bit. It's what you hear from most big firms. And we can manage money differently. We don't have to be all in or all out, but you also don't have to just blanket the whole universe and invest in everything. I mean, you can just go buy the S&P 500 and probably be just as well off. But Lance, what do you think about right now? So, the other big headlines right now is that, we're going into QT. We've been a little bit different than other countries because we stopped the rate cuts. I mean, now I just saw what Fed Watch is essentially saying 50% cut, likelihood of a cut in May, 80% by June. And those numbers are going to change, right? It went from, we were hot to trot on cutting rates till we weren't going to do it. Now we're back to looking like you will see some rate cuts. But they're cutting interest rates. And one thing I'm hearing a lot about now is like, we need to be in international markets. What's your thoughts and feelings on that?
Well,
I know what they are. I want you to.
Yeah. International markets are doing fine right now, right? They're doing great right now because the dollar's declining. So money's flowing out of U.S. markets going back in international. So you're seeing this reversal trade of what was driving U.S. markets last year, and emerging markets were declining. We see this every year, almost every year going back for the last 15 years. This is the year for emerging markets and international, and then they all fall apart. The problem is that twofold. One, emerging markets, their economies are directly tied to the economy of the United States and Europe, basically. That's their primary trading partners. So if those countries go into recession, it's kind of like we get a cold, they get the flu. So that's going to certainly impact their earnings, their exports, all those type of things. The international markets are all on the verge of recession. They're cutting rates. They are literally at the brink of recession. Germany's probably in a recession right now. So again, that's going to show up in their market. So again, right now you're getting a rotation trade into emerging markets because of the decline of the dollar, but now the dollar is very oversold. I would be a seller here of emerging markets international and start buying U.S. domestic for a trade.
Yeah, that's fair.
And I wouldn't touch small cap right now.
Yeah, I mean, small cap, what is it, a 15% decline versus a 6% decline? And, everybody's saying how cheap it is.
It's not cheap. It's cheap on a relative basis, but again, this is the big concern. And that's also one of the big fallacies about emerging markets.
We've been hearing that for decades.
Yeah. Well, they're cheap relative to the U.S. That's true. They are cheap relative to the U.S., but they're not cheap relative to themselves because they're slow growth economies, et cetera. So again, you just got to be careful, kind of where you invest. Doesn't mean you shouldn't own them. They are certainly tradable assets. They've done well this year if you've owned them, but I think holding them will wind up being an anchor on your portfolio just like they've been over the last 15 years.
Maybe that's something we talk about next week.
Sure.
The how to diversify, how to trade those, because I think, too often we're just trading on headlines versus actual data.
Yep. All right. Quick break. Not quick break. We're going to wrap up.
Long break.
Be back tomorrow with Michael Leibowitz and, of course, more of the Real Investment Show. Get by the website, realinvestmentadvice.com, our Substack channel, @Lance Roberts. Be sure and like and subscribe to our YouTube channel. We certainly appreciate it. And we'll see you back here tomorrow.